Hi, I'm Adam from Palmer's Accounting. One of the most common questions we hear from business owners is this: how much should I be putting aside for tax? It's a good question, because the last thing you want to do is reach your year end and realise all the cash you need for your tax bill has already been spent. In this video we'll focus on corporation tax and how to plan ahead for it. If you run a limited company, your business pays corporation tax on its profits. That means the tax is calculated after you take away your allowable business expenses from your income. So the higher the profit your company makes, the higher the tax bill will usually be. At the moment, most companies pay their corporation tax at either 19 or 25% depending upon their level of profits. A common problem is that business owners look at their bank balance and assume the money is available to spend. But some of that cash actually belongs to HMRC. Remember, your tax bill isn't calculated and paid until after the end of your accounting period. So, if you're not setting money aside throughout the year, the tax payment can come as a surprise. As a general guide, many businesses set aside around 20 to 25% of their profits for corporation tax. It's not an exact science for every company because your final tax bill will depend on things like your exact profit level, allowances and reliefs, capital purchases, and any tax planning that's been done. But putting aside that percentage regularly helps ensure you're well prepared. One simple habit that works well is to move your estimated tax into separate savings accounts each month. That way the money is set aside and doesn't get mixed up with the cash you use to run the business. When the corporation tax bill arrives, the funds are already there. It removes a lot of stress and it makes your cash flow much easier to manage. The most accurate way to plan for tax is to review your numbers during the year, not just at the end. When you regularly review your management accounts or forecasts, you can estimate your tax position much earlier. That means no surprises and more time to plan properly. So, in summary, corporation tax is based on your company's profits. Many businesses set aside around 20 to 25% of that profit as a guide. And reviewing your numbers regularly helps you stay ahead of the bill. If you'd like help forecasting your corporation tax or understanding what your likely tax position will be, come and talk to us here at Palmer's. We can help you stay ahead of your numbers and avoid unexpected tax surprises. Subscribe for more episodes in the Behind the Numbers series, and we'll see you next time.